Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
Well, it wasn't raining on Monday, so you would think that would be a good day for rates, but it was crazy hot, which I would take as bad weather. So my theory on bond movement or bond yields moving in the same direction as bad weather stands as we start the week. But welcome everyone to the Tuesday edition of Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer at Town Bank Mortgage right here in Wilmington, North Carolina. We break down the top stories impacting mortgage rates every single weekday, at least Tuesday through Friday, unless, of course, take a 1 month sabbatical, which I'm not right now, so we're good. All right, so it was not a good day for rates. I mean, it wasn't awful, it wasn't horrible, but we got some trouble brewing. Some trouble is a brewing. And it's a little worrisome. We did get some good economic data with regards to manufacturing. We got the New York State Empire manufacturing report, which was pretty good. Manufacturing activity in the New York area, almost a 5-year high. I think it's a 4-year high, almost a 5-year high. And then Homebuilder confidence, a little bit better, but really nothing to write home about. But the real story was the 30-year yield, which rose to the highest level since 2007. If you remember 2007, that was the beginning. That was the beginning of the Great Recession. And so probably not a good time to be compared to. But yeah, on Monday, the yield on the 30-year U.S. Treasury rose 3 basis points to 5.29%. That is the highest level since 2007 and within striking distance of that year's peak, which was 5.44%. So we got some way to go, but wouldn't exactly write it off. And there was a lot written about this. A lot of different outlets and others commenting on this, either before this happened or after it happened. Bloomberg's Greg Ritchie noted that on the sell-off, the sell-off isn't isolated to the United States. Long-term yields are rising globally as investors demand greater compensation for the risks associated with mounting government debt and persistently elevated inflation. Basically, investors are saying, hey, we're looking at these debt loads that are the United States, we're going to run over a $2 trillion deficit this year again. So every year we're adding $2 trillion to the national debt. And we're not alone. No country has returned to pre-COVID levels. It's like we spent a ton of money and then we're just like, all right, here's the new baseline. And it's big. And so investors are like, I'm not taking 4% on a 30-year bond because that's going to be eviscerated by inflation. There's no value there. And then those bond holdings are going to lose value and problems with portfolio and everything else. And this has been illustrated by Robin Brooks, who I've talked about many times here on the podcast, has a great Substack. He talks about Japan a lot. And he even wrote recently that they're basically in a de facto debt crisis that's being hidden by their central bank buying up their 10-year. And even that's not slowing it down. We're seeing the 10-year rise in that country. But it's, once again, not just isolated to one particular country. This is globally. Every country is just running massive fiscal deficits and just doing nothing to stop it. In fact, the only thing we ever hear is that, that's what we're hearing out of, the UK, Japan. We keep hearing about how we need to spend more. That's the problem. We're not spending enough. We need to stimulate the economy. And it's like, at some point, we're going to have a problem with the multiplier effect. But Robin Brooks wrote it on Sunday, so this is before all of this happened. He said that softer U.S. inflation reports have caused markets to reduce expectations for additional Federal Reserve rate hikes, which normally, when we did see a little bit of downward movement, but nothing crazy. Under normal circumstances, a lower probability of a Fed tightening should push long-term yields down. Instead, they went up. Brooks wrote, that's a really worrying sign because it means markets are beyond rewarding the usual good news. And then Citadel's Noshad Shah argued in an investor note that investors are increasingly skeptical that policymakers will make difficult decisions necessary to contain inflation and government borrowing, saying, quote, in my mind, this reflects a market view that policymakers, both the Fed and fiscal authorities, tend to take the easier route when faced with difficult choices, which is very true. So last week we had a 3-year auction, which was great. A 10-year auction, great. 30-year auction, dud. And that is now filtered in to this week. And like I said, it's across the globe. It's across the world. We are seeing long-term yields rising in every major country. And so, the good news for the mortgage industry is that we're not based on the 30-year. Even though it is a 30-year fixed, we're based on the 10-year. Now, that spread is a little higher than we would like it between the 10-year and the 30-year fixed. We are still based on the 10-year, which, like I said, it was up a little bit today. It was up about 2 basis points. Nothing crazy. But the concern is that it's going to kind of like filter its way through. So it's starting with the longest term yields. But eventually, as things get worse, it's going to make its way through. And we'll get to the 10-year. And so that's one of the concerning things. And so not a great day. And the problem is it's not like, it's inflation's a little high or, manufacturing's having problems. It's nothing that's like a report is going to fix. This is fundamental systematic problems that we are borrowing too much money, which is causing inflation. And no one is serious about handling that situation. Now, Warsh might be. We keep hearing these, he keeps commenting on he respects the target rate and how important the target rate is. But we haven't seen any action. I mean, there are things that are happening with like some of the systems that are, behind the scenes that the levers that the Fed controls. But then, recently we had Scott Bessent, who clearly was freaked out about Japan possibly selling treasuries in order to buy up yen on these foreign currency exchanges in order to prop the yen up. And so that opened up one of those Fed levers and opened up this tool, which is once again not putting a stop to those things. We're not turning off the faucets anywhere. All the plumbing that's happening kind of behind the scenes. We opened them up full blast during 2020. And while we may have reduced the flow, we haven't stopped them. And maybe that's what Kevin Warsh is going to do. We will see. But these are big issues that can't be solved with just a good inflation report or a good jobs report. These are systematic problems. That's, once again, not just us. And I mean, if you look at it from like a growth perspective and an economy perspective, we are the best. I always tell people that as awful as things are, we're the best. But it doesn't mean we're doing great. So yeah, I mean that's kind of the problem is that we're having a problem and it's not something that can be fixed with a solid jobs report or inflation report. All right. Homebuilder confidence. We got that report. It was good. It was up slightly in August, but still pretty darn close to all-time lows. The National Association of Home Builders Wells Fargo Housing Market Index was up 1 point to 35. However, that is the second lowest reading in the past 11 months. So like I said, nothing to write home about. Regionally, it was all positive. That's the good thing. The Northeast rose 1 to 42. South climbed 1 to 32. I'm sorry, Northeast rose to 42, the South climbed to 32, and the West increased to 27, all 1 point rises, and the Midwest held steady at 45. And then we didn't see a lot of movement with the major categories that make up the home builder index. For example, current sales conditions did improve 2 points to 39, but future sales and prospective buyer traffic both were unchanged at 43 and 23, respectively. Builders continue to rely heavily on discounts and incentives to generate demand. 35% report cutting prices in August, down from 37% in July, with the average reduction holding at 6%. And then 63% of builders offered some form of sales incentive, unchanged from July. Robert Dietz, chief economist, National Association of Home Builders, did say, elevated prices, elevated rates. It's basically what it comes down to. And the problem is that a lot of builders are offering incentives, but those crazy incentives they're still there. But as we've talked about here on the podcast before, a lot of that comes from them pricing it into the home. And so it's like, you can go with a new builder, especially the bigger builders. And they have in-house lending, so they're one and the same. And they'll be like, we'll give you a 4.99% mortgage, $12,000 in closing costs. And then you go to buy the house and you realize that you paid $40,000 more than everyone else because they priced it into the house. So it's like, I hope you like that house because you're not going to be able to sell it because you're not going to be able to offer a 4.99% mortgage and $12,000 in I guess you could. But they're pricing it into the house in order to justify that. And they can't take that hit anymore. They got to price it into the house because a lot of the houses that were built in 2020, 2021 before prices really skyrocketed. So they did have a bigger spread to work with. They don't have that anymore. It's a lot smaller. So they have to price it in another way, and they're pricing it into the house in a lot of cases. So get the benefits, but you're paying for it one way or the other. So it always works, right? Something's too good to be free or too good to be true. It probably isn't. All right. I mentioned manufacturing. Great report out of New York. The Empire State Manufacturing Survey's headline General Business Conditions Index climbed 5 points to 20.6 in August. Highest reading in more than 4 years, almost 5 years. We're like 3 months away from 5 years. Demand remained healthy while the new orders index registering 17.3 and the shipments index came in at 11.7, which signaled continued solid growth in both categories. We also saw some strength with unemployment. That index was at 9.3. While the average work week index rose to 6.9, indicating manufacturers continue to add workers and employee hours. The only major concern, as always, inflation. The prices paid index jumped 6 points to 58.6, signaling that manufacturers are once again facing faster increases in input costs. Now, the prices received index fell to 22.7, suggesting that businesses are raising selling prices at a slower but still elevated pace, so maybe they can kind of absorb some of that. But a strong manufacturing report. Always want to see that. Never a bad thing. But that was really the only solid economic report that we got, but it showed the one concern that we all have, which is inflation. So all in all, kind of a rough start to the week, I will say. A little bit of a rough start with 30-year bonds rising. Once again, not filtering into the 10-year. So we are still seeing, nothing crazy. The 10-year finished the day above 4.7%. So, and I do believe that's a 52-week high. So we are seeing some upward movement in the 10-year, but nothing as bad as the 30-year. But we got to keep an eye on that 30-year. So rough starts of the week, weather-wise, news. We got a lot of housing data. We got Fed minutes. I think we got a 20-year bond auction. I think we have a 20-year bond auction. That's good. That's right in the middle. So we're going to see, right? We had the 10-year last week was good. 30-year bad. Now we got it right in the middle, 20. So 20 might be more interesting than normal. Because is it going to be more like the 30? or more like the 10. We will see. All right, you guys, enjoy your Tuesday. We'll be back here Wednesday for another edition. Trying to get my days right. We'll be back Wednesday for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.